In this video, I'm going to talk about how you can make your traditional 401k tax-free and potentially even your Social Security tax-free. Hi, my name is Pascal Manigat and you're watching the Financial Ownership Podcast. So if you followed my content before, I talk a lot about different types of ways to grow your money, retirement accounts, using insurance and all that type of stuff, and different types of vehicles to protect and grow your money. And you might be thinking, how do you make a traditional 401k tax-free? Some of you might be contributing to a 401k plan and you might be thinking, don't I have to pay taxes later on to it? And for those of you that may be new to my channel or might be watching this content for the first time, the way a traditional 401k works is you take a deduction on your income. So if you make $60,000 and you deduct $10,000 from your income by putting it into a 401k, what you're doing is deferring your taxes for a later date. So later on, when you build a lot of money in that account and you take it out, usually it would be taxable. That's the way it would work, and that's the way most people use 401ks. They pay taxes on the back end later on when they decide to take distributions from their assets. So some of you might be thinking, how can I make my 401k, my traditional 401k, remember I said traditional, not a Roth account, tax-free? And not too many people know how to do this, and this is why you really should make sure you stick to the end of the video, because you're going to actually learn a lot on how you could potentially save a lot of money in taxes in the future. So some of you that file taxes, it's getting closer to that time of the year where it's getting closer to taxes. What you get to do with your income is that you get a standard deduction. So currently the standard deduction is about $13,000 for 2022. It's actually about $12,950, that's the exact amount. What you can do is take distributions from your 401k and your Social Security combined if you want to do that, and take just enough from those accounts where it matches the standard deduction. So the benefit of doing that is when you're taking money from those accounts and you're matching the standard deduction is you don't have to pay any taxes on that money. And the thing is, when you're looking at standard deduction, right now it's about $13,000, but 20, 30 years from now, it's gonna be a lot higher. So it's gonna adjust about the rate of inflation. So around like 3% or 4% potentially, depending on how high inflation is. Inflation has been pretty high nowadays. But nonetheless, what you can do by planning ahead financially is you could find that sweet spot where you're taking money from your 401k and you're matching your standard deduction. And the thing is, when you do that, you take advantage of taxes in two ways. You're deferring taxes and you're not paying taxes on the front end. So you're basically, when you make that $60,000 salary or whatever you make, you're deducting that money from your income, and later on when you take out money, you're not getting taxed on it because you're just taking out the standard deduction from your 401k. And some of you might be asking, yeah, that's great and all, but if standard deduction is about $25,000, how am I gonna live on that? That's not enough money. Yes, I agree with you. If that's all you have, $25,000 to retire on or for the future, and you're trying to replace your income or you're trying to replace your lifestyle, it's not gonna really be possible, right? But that is why you want to take advantage of other tax-free asset classes. So cash value life insurance, potentially even real estate. Some real estate gives you benefits of depreciation deduction. I'm not gonna talk too much on real estate because I'm not a real estate expert, but at the same time, it does give some great tax benefits like depreciation deduction, and you don't have to pay taxes on all the income. And also Roth accounts. So by taking advantage of those tax-free asset classes, what you can do is you could save your excess money, whatever that past that standard deduction that you're trying to reach with your 401k. If you're trying to save extra money, put it into these tax-free asset classes like cash value life insurance, real estate, and Roth accounts. So later on, you're taking that standard deduction on the 401k, and later on, when you accumulate money in those tax-free asset classes, the way Roth accounts and cash value life insurance work are you don't pay taxes in the future. You're basically paying the taxes upfront. So if you make $60,000, what you're doing when you're paying or you're putting into a Roth or cash value life insurance account, you're paying taxes right away. So later on, you don't have to pay taxes in the future. There's no income tax liabilities at all in the future when it comes to saving those type of accounts. So the benefit is that when you're putting money into a Roth account or a cash value life insurance account, it's not going to count towards your taxable income. So you could take as much money as you want from those accounts and not have to worry about your tax liabilities. But in the 401k, it's a little bit different. You do kind of have to worry a little bit about your tax liabilities. So Roth accounts let you contribute up to $6,000 currently. And cash value life insurance has an unlimited cap to how much you could contribute into it. So you just have to figure out how much money you want to set aside for the future and things of that sort. And just put your money in those tax-free buckets so later on you don't have to pay taxes in the future. But in order to do a strategy like this, it's gonna really take some forward thinking and some financial planning, because you're gonna have to do a little bit of math and figure out like the adjusted standard deduction rate in 20, 30 years or whatever this period you decide, or whatever period you think that you're gonna be done working or done earning income per se. So you need to figure out whenever that is and do a little bit of math based on, say, a 3% adjusted inflation rate. How much you would need to put in your 401k in order to get, say, a $20,000 or $25,000 income from your 401k, so you don't have to pay tax on it by using the standard deduction that you're allowed to use within your taxes. So the great thing about this is it's perfectly legal. And not too many people know about strategies like that. They kind of just go with the idea of, I have a 401k, I don't really have to think about anything else. But you really do have to think about all the different types of tax liabilities and all the different other types of risks that are associated with just putting your money in that one account. And that's what most Americans are putting their money in, is just putting in 401k, and they're not really thinking about other things, whether it's tax planning, retirement planning, whatever it is. They're not too concerned about how that's going to plan out in the future for them. But in most cases, for most people, just doing that, just putting money in a 401k isn't going to be enough. But if you ask me, if you're trying to take advantage or you're trying to maximize your retirement income later on in life, it's a very good deal, if you ask me, if you defer your taxes and you don't pay taxes at all because you're taking advantage of standard deduction. Because essentially you're taking advantage of taxes in two ways. It's money that you never paid taxes on, and it's actually a great advantage or a great way to grow your money for the future if you're looking to just go the traditional route of planning for retirement and using things like retirement accounts and 401ks and things of that sort. So if you're actually looking to do that, that's actually a great way to strategize and plan and maximize the money you're gonna have in the future. And it's not a very difficult process to do something like that, especially if you just started working. If you're a younger person, you just started working, you can start planning this right away. And you don't necessarily have to think about too many things, because it's going to be relatively simple math on how much money you have to put aside in each bucket in order to maximize your tax-free income that you're getting from each asset class. Obviously, if you're a little bit older, it's going to be more difficult, but it's still possible. It might be a little bit more planning, because you have to figure out whether you have a pension or you have a 401k, where's your money coming from, and how much money that you're going to be getting in terms of taxable income from those asset classes. And even if you didn't get to, say, 0%, like where you didn't pay any taxes on your money, let's say that you have, say, $20,000 that you're getting in taxable income. If you're only paying taxes on $20,000 and the rest of it is coming from tax-free asset classes, that's still really great if you ask me. And you have to remember, it's an unlimited amount of money that you could have in those tax-free asset classes. It's just a matter of planning ahead and planning properly in order to take advantage of those type of things. If this is something that you're interested in implementing for yourself, in the link below, there's a link to my Linktree where you could book a discovery call and ask me any questions that you want about anything, whether it's about this or other types of financial products or financial concepts. And I post financial content every single week, so feel free to like, comment, subscribe if you enjoy content like this. Thank you.